In today's episode, we talk about the different types of venture capitalists, we talk about what motivates the investors, and how VCs make money.
Learn more about the do's and don'ts in venture capital.
Welcome to episode 1 of this podcast series, Venture Capital Deep Dive. In this podcast, we talk about everything a first-time founder needs to know about the why of a venture capital investor. This podcast is brought to you by btov Ventures, a Switzerland-based venture capital fund established in 2000 and focused on early-stage startup investing. And I am Cédric, your host of this podcast and the founder of globaltechbooks.com, a video platform focused on insightful interviews with experts around startups, tech, and innovation. Make sure to check them both out. Alexander Stoeckel is a partner at btov since 2012, board member since 2014, and is actively seeking the best entrepreneurs and most promising startups. You can reach him over LinkedIn and email. In today's episode, we want to talk about the motivation of a VC and including all the different types of venture capital funds. So first of all, Alex, maybe explain to my audience why you decided to become a venture capitalist.
So I have a background in business administration and started my career working in banking. And if you work in banking, you will at some point find out that it's not that much excitement, really, because you tend to invest in mature companies. You're looking mostly at balance sheets and P&Ls. And on very rare occasions, you get to meet the entrepreneur. But in many cases, you have a distance between yourself and the company you're investing in. And so at some point, I realized that investing in young companies and young entrepreneurs is much more exciting because you're really working with motivated, passionate people. You're investing in cutting-edge technology. So this is much more exciting. And still, if you are successful, you can make a decent living and be successful, make a name for yourself. So this is what got me into venture capital, I guess.
Now, when you look at all the different types of investors there are right now, you are a venture capital. We'll be talking about this a little bit later, but maybe you can elaborate of what other types of people and organizations are investing in startups.
I think it's a whole ecosystem. So you're looking at family, friends, and fools as the most important and earliest source of capital for young entrepreneurs. So your family and friends invests in your idea and gets you off the ground, basically. And then I think the second most important element is business angels. So you find entrepreneurs in the market happy to invest in young entrepreneurs and sharing their experience, intelligence, etc. with you, and also giving you money, obviously, to get the company started. Then there is a broad variety of government-funded initiatives. So it's a couple of programs, both in Switzerland and in other countries in Europe, where startups can get funding, training, education, etc., etc. So I think that is also important in the very early stages of companies. Then we have incubators, accelerators. Some of them are financed by big corporations. Some of them are financed by universities. Again, they play a very big role to get a startup to a point where it becomes viable for venture capital. And then obviously the VCs, and then you can distinguish between corporate VCs and private VCs, they play a role if you are about to enter the market or if you have already entered the market and have generated some first traction with your company, and then come in with bigger tickets ranging from 1 million to 10 million, basically.
So in this episode, we really want to understand what btov is and venture capital in general, the motivation behind venture capital. Maybe you give a short summary about btov, what you guys do here.
So btov Partners has a fairly unique setup because it's a venture capital firm and also a private investor network. We have successfully raised 8 funds so far. 5 of them are proprietary btov funds, labeled btov, where we design the strategy, where we raise the funds, etc. So these are really our funds. Then there are 3 managed partner funds that we manage on behalf of and in close cooperation with big corporations and ultra-high net worth families, such as Ringier and Helvetia, for example, in Switzerland, and a big family office, which name I cannot disclose, unfortunately. The interesting thing about btov is that we are, at the same time, a business angel network. So we have 250 members, all of them private investors, come from various industries, all of them have an entrepreneurial background, and they do not only bring in investment opportunities, but also their expertise, their know-how, their intelligence that we use in all the aspects of the venture capital investment process. So they help us in terms of origination by bringing new investment opportunities to us, selecting, so they help us to select the most promising targets, talking to the entrepreneurs, helping us in the due diligence process, but also after we have invested. So they are able to open interesting doors for the entrepreneurs, give advice based on their own experience coming from different industries, and eventually even help them with the exit. So the setup of a venture capitalist working closely with a private investor network is what distinguishes btov from the rest of the market.
Now, when you look at like your daily schedule, first of all, like what is it that excites you every morning to get up and like talk to all of these entrepreneurs?
I think it's the unpredictability of the day. So when I come in the morning, first I got thrown out of the bus by 50 emails that have incurred since last evening. And then many of them will be introductions of new startups. So I will briefly scan through those, forward most of them to our screening team, where they get analyzed properly and evaluated, and then represented by the end of the week or maybe next week to the other members of the group. Then there is portfolio work. So I will talk to entrepreneurs where we already invested. I will talk to investors that have been investing with us or are helping us with an investment to get it off the ground. There's a bit of troubleshooting, obviously. So many of our companies have certain issues to deal with, and we try to help them solve these problems and overcome these challenges. And then in the evening, in the afternoon and the evening, there will be investor relations. So I will talk to prospect investors in btov or prospect investors in the companies we find most interesting, and also work on new cases. So the ones that have been screened already and that are in the due diligence process or maybe already in the structuring process will come to my table, and we will see whether or not we can bring in one of our funds and maybe a couple of our investors and have an interesting setup for this founder team.
Now, you know, many times first-time founders, like they have no idea like why venture capital funds are giving away money to startups. I don't want to say like they think it's charity, but like, you know, it's definitely something that people are expecting a return on investment in some way or the other. Maybe you can explain first, like in general, how is a VC set up? How does it work? And how do you as a VC make money?
So VC organizations tend to be small and lean. So you're looking at basically an inverse pyramid. Usually you have a number of senior people, partners, principals, and then a smaller number of investment managers, associates, analysts, and then maybe some small back office team that's helping you to just schedule travels and make dates and appointments, et cetera. So it's a fairly small and nimble organization that's able to really focus quickly on new topics and new deals and do not put too much burden on the P&L of the venture capital firm, basically. What you're doing is you're trying to build yourself a reputation for success and ethical and fair behavior towards founders, basically, because this will in turn generate deal flow and bring the most interesting startups to you. If you're looking at the deal flow of a venture capitalist, it sounds as if there's a competition in terms of magnitude of the deal flow that you're looking at. So at btov, for example, we are looking at about 3,000 investment opportunities per year, which is roughly 60 per week, which is a lot. But you're really looking for the one target that has the potential to become an outlier. So you're not necessarily trying to find many targets. And if you go and attend, let's say, a startup conference, for example, on very rare occasions, you will bring back one or two promising targets. On many occasions, it's either zero or just one that you find interesting and that you will focus on, which also translates into what entrepreneurs should understand. We are looking at a broad variety of different investment opportunities, but then at the end of the day, it's a very narrow funnel of like 10 to 15, sometimes 20 companies a year where we end up investing. So don't be frustrated by the rejections that you may receive from a venture capitalist, because it's really part of their process to focus on the most promising target that's out there. And the other ones usually get substantial feedback in terms of, sorry, your company is not mature enough, or sorry, the technology does not really fit into our investment strategy, or apologies, but we find this and that aspect of your venture not convincing, so we have decided not to pursue this investment opportunity any further. But don't be frustrated, because it doesn't necessarily mean that you have a bad startup or anything. It just means that you don't fit into the strategy and focus of this particular VC you're applying to.
Now, when you look at, again, like your daily schedule, what do you think is, let's say, the most fun part of being a VC?
I think the most fun part is when the analysts and investment managers present incoming investment opportunities, because you get exposed to a broad variety of interesting investment cases and technologies and teams working on interesting stuff. And on many occasions, I found that I was just surprised by what people are trying to achieve. So I remember when, for example, my colleagues pitched me Volocopter for the first time, which is basically a flying taxi. This sounds like something from a fairy tale book, right? It's a flying taxi, so how does it work? These are the occasions that I find most interesting and most rewarding in being a VC. And there's obviously also this moment when you get to meet founders, because many of them are on very high energy levels, very smart people, very clever, very creative, also very funny. I get the feeling that entrepreneurship requires you to have a certain degree of humor, so that's a good thing. Many more aspects, obviously, but these are the ones I find most interesting.
Now, the flip side, what is hard for you?
The tough part is to see teams fail, and then at some point, maybe you also have to discuss how to wind down the company you have invested in. Especially after working with these teams for 2, 3, 5, 7 years, this is a hard thing to do because it means that, first of all, the team is not getting more funding from the VC and has to, at some point, stop operations of the company they're working on. But it's also on a personal level because you get very close with these people over the years, and then it's a hard thing to say, I'm very sorry, but we don't think that we can invest more in your company. So either we find some external source of funding, otherwise, I'm very sorry, we have to stop right here and think about how to wind it down, really.
I just want to go back because I think we didn't really touch on that, like how a VC makes money.
So the standard business model is 2 and 20. So you have 2% management fee and 20% carry. Then there is a bit of variance whether you charge the 2% management fee on the committed capital, so what has been invested in your VC fund, or the invested capital, so based on what you have already invested in startup companies. But that's how you make money. So looking at the standard VC, if you are an entrepreneur and you want to get an understanding of what you're looking at in terms of revenue that these guys are making, just multiply the assets under management with 2% and you get a rough estimate of what this VC is incurring in terms of revenue. The VCs are not in it for the management fee. In fact, there's a saying in the industry that goes, they came for the carry and they stayed for the management fee. The carried interest is the success fee that we get if our investments turn out to be very profitable. So that's 20%, meaning that first the entire portfolio is paid back. So the investors get their money that they invested in back in their pockets. Then there is some sort of hurdle rate, again, depending on the individual VC. That varies between something on the order of 4 to 8%. And then whatever is left in terms of performance is divided, 80% go back to the investors, 20% stay with the VC. In certain cases where you really managed to invest in an outlier, this can be quite substantial and can be a very nice bonus for the entire VC team.
Now, when you look at, let's say, the timeline of a VC, how long are they usually in business? How long does it take for an investor to get the money back? What does it mean for the entrepreneurs?
So the average runtime of a VC fund is something order of 10 to 15 years. So at btov, it's 10 years plus 2. It's a prolongation that we can opt in. It's really a long investment period you're looking at. So if you compare it to real estate or equity, it's by far less liquid and more difficult for investors. The other thing you're looking at is VC tends to get better in the second fund and the third fund because they have more experience, they have a stronger reputation in the market, they get access to better deal flow, they are more experienced in terms of making deals, etc., etc. On the other hand, if they are too successful, there can be the phenomenon of rise and fall of the Roman Empire. So you might end up with a VC that got so successful that he or she is able to raise significant funds, like, I don't know, 200 million, 500 million maybe. And then there's a question whether they can still keep up the good performance because now they're looking at very different numbers in terms of their investments, in terms of how many deals they are making every year. And then there's a question whether or not they are motivated enough and strong enough because at some point, obviously, everybody gets more and more carried interest. The management fees rise as well. So that can be a challenge. However, I think in Europe, there are very few of these, if you will, VCs in decay because the industry is still growing strongly and everybody is still striving to build a reputation for themselves. So right now, we are still in a very strong and positive period, I'd say.
When you look at, let's say, this from an entrepreneurial perspective, when is a good moment for an entrepreneur within the life cycle of a fund to be approaching VCs?
You shouldn't focus too much on the life cycle of the fund. You should really think about, is my company at the right level to be attractive for this VC at the moment? I think many of the rejections that we send out are based on what I said before. Sorry, but your company is not mature enough, meaning that doesn't mean that your company is not mature enough in terms of like you're not mature enough, but in terms of you haven't generated enough traction to become interesting for us, because our investment strategy determines that we want to see at least, 6 months of revenues, more than 10,000 users, depending on what you're doing, really. And if you approach the VC too early, they will get back to you and say, sorry, doesn't fit in our portfolio. And sometimes this can be misinterpreted as, they're injecting our case fundamentally. But in many cases, they're just rejecting it because it doesn't fit into their strategy. And so my advice would be, look at the website, look at the investment strategy of the individual VC you're talking to, find out if he or she invested in similar companies in the same industry, what the track record was, what they say about their own investment strategy on the website, are they Series A investors, Series B investors, etc., etc. And if you can, also do your due diligence on the investors. So talk to entrepreneurs they have been investing in the past. Just call them up, ask them how does B2V, for example, behave when they invest. And this will give you a good idea of how to really tackle this individual VC you're looking at.
That's a great segue to my next question, because I want to ask you anyways, like what would you say like makes a very good and a very bad VC?
I think a very good VC is, first of all, humble, so he doesn't overinterpret his own position. We are supporters and backers of entrepreneurs. We are not ourselves responsible for the big success story. I mean, we can certainly contribute and do good stuff. If you're talking to a veteran VC, he will say, look, I'm just giving you a fuel to really make this car go. And then maybe I can open 2 or 3 doors. I can introduce you to some interesting candidates, or I can bring you in touch with interesting people from your industry and maybe potential exit partners. But I will not run your business. I will not impose myself on you as an entrepreneur. You are better suited to manage this company, and I will trust you. I will always back you. We can have discussions between us about how to, tackle this and that problem or think about the strategy. But towards the outside, I will always be at your side. I will always be your partner and support you no matter what's happening out there. And I think that are the markings of a good VC in my eyes.
And the flip side, the bad side of
the bad
VC?
side would be a VC. So first of all, who has weird terms on his mind, for example, like I will take 60% share of this company in the seed stage. Too much putting himself in front of the business, so really imposing himself on the entrepreneur, saying like, oh, this is how you should do it. You shouldn't talk to these guys. This is how I want you to do this. And also, sometimes you can read it in interviews when they say, we did this and that. That confuses that. In fact, the entrepreneur is doing it, and we are just backers and supporters, and we're not really doing it. It's really the entrepreneurs who are running the show. Sometimes you find that the not so good VCs pretend to be bigger than they are. So I have a German word for that. I'm not sure how that translates into English. It's taken from a Michael Ende book for children. It's called The Scheinriese. So it's somebody, there's a figure in this book, looks very tall from the far, and then the closer this person gets, the smaller they become. And that can be a marking of a not so good VC as well. They look very tall from the far. They have fancy slides, fancy office, fancy whatever set up for themselves. But then the closer you work with them, you find, they don't have that good a network. They don't have that much experience. They're not that good a supporter of my company.
The last topic for the first episode is about like the industry knowledge that you have to get. Like you said, like you get presented 3,000 deals every year. Where do you get this knowledge from, being able to assess so quickly about whether it's a yes or a no?
I think at B2V, that's a very smart part of our business model and setup, because I don't have to claim to be the best expert in whatever industry field you're working in, because I have people in our private investor network who come from that particular industry and can give me their opinion or can introduce me to other experts even if I need a deeper understanding. So I would say that it's very helpful to have a natural flair for technology and have a good understanding of how technologies in certain markets work, and experience couldn't harm. So if you have already invested in a number of similar or slightly similar business models, that can be advantageous. At the end of the day, I'm thinking you're looking at individual cases, and you have to really make up your mind what would be the best due diligence process for this particular startup, and how can I share this setup that the startup has with people from my network that can give me their second opinion, third opinion, fourth opinion. It's not really a 2I principle decision. It's really you're involving people from your network, from your company, getting other people's opinions, and then at the end of the day, take the investment decision.
And the last topic is really about like these megatrends. Also, like you just set up the industrial fund. So like there must have been like some kind of decision making about like, okay, industry is going to be the next fund, the next focus. How did you make this decision?
I think that would be a strategic thought, because so you can look at the venture capital industry and ecosystem as a whole and find that industrial technologies, so B2B, deep tech, sometimes hardware-related technologies, are very difficult to fund these days in Central Europe. So we have put together what I think is the most amazing team for that particular sector, including Christian Schütz, Christian Reitberger, who's been a veteran in the industry, Robert Gallenberger, and Benedikt Kronberger. And these guys are what I would consider the best industrial technology experts in Europe at the moment. And I think they're tackling a segment that is not as heavily populated as, for example, digital technologies, where a lot of players are active in the market right now. So it's a different setup in terms of bigger tickets. They're looking at slightly later stage companies, so Series A and portfolio and ongoing. I think that is really what drove our plan behind this fund and this structure.
Good. Thank you so much for being here for episode 1. I mean, next week's episode, we will talk about where VCs get their deals from, what founders need to know about pitching a VC, and how to reach out to venture capital funds. Make sure to be there when we publish the next episode. Thank you so much, and I'll see you in the next one.
My pleasure.